Welcome to the daily update, where I'll go over the action in the market for Friday, August 15th, and we'll see how things look for Monday, August 18th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, the market's still positive overall. We had the S&P set another intraday all-time high, but that was right at the open, and then we spent the rest of the day chopping around and ended up closing lower on the day, seeing a little bit of weakness coming into the market, and it's kind of frustrating to see a lack of follow-through to the upside. But in the bigger picture, things are still positive overall. So right at the open, we had a higher open, and that's when prices set the intraday high. That was at R1 at 64.81. Now we're also watching the 64.68 level, and I'll show that to you in different charts and point it out as I'm going through some of these charts here. But we didn't close above that level. So that's longer term. It's an overhead pivot point resistance level. And so on the weekly chart, even though we're still looking positive, we haven't cleared that overhead resistance, at least yet. But we were above it on an intraday basis, and then we declined below the unchanged level. That's when we went negative. We got below the daily pivot at 64.61, and then we chopped our way down to S1 at 64.48. Then we chopped between S1 to the downside and the daily pivot to the upside, and we closed slightly above S1. Okay, so then we were down 0.29%, not really big on a percentage basis, but what's quite often in the summertime, we were still below average with volume. We're still positive on all time frames, in the short, intermediate, and long term, but we're not seeing a lot of enthusiasm right now. And interest rates are going back up. Now, we're not at that 4.5% level yet, but we're inching our way up to that, because when PPI came out on Thursday, that took the markets by surprise, and now the fear of inflation is starting to come back into the market. And first, if it starts out at the producer level, people that make things, is that going to transfer over to consumers, the people that buy things, and make the CPI show more inflation as well? That's kind of the going fear for the time being. And of course, you've got the summit going on right now between Putin and Trump in Alaska. The last headline I saw was there was no real deal reached, but at least the two of them are meeting face to face, and we'll see if that can possibly lead to something more. All right, so some comments. Now the Dow, if it had closed up, it would have set a new all-time high. It set an intraday high, but then it ended up closing down, just like the S&P. And then Chicago Fed President Austin Goolsbee, all right, who's now a voter on the FOMC, noted that inflation readings have been mixed, and that's true. If you look at CPI, that was market friendly. If you look at PPI, that has folks concerned. He cautioned against overreacting to a single month's data. All right. Well, the market is sometimes guilty of not just a single month, but a single day. It goes crazy for a day or two and then moves over to something else to go crazy about, either positive or negative, emphasizing the need to discern which prices can be disregarded. Okay, all right. Mega caps held up better, while small caps, now that the fear of inflation is coming back in, the upward move we saw in small caps and mid caps earlier in the week, that's starting to go away again here. On a short-term basis, we're still seeing pretty good short-term momentum. Now, not all of our indicators are on here. The Stochk RSI is not on this list, but the Williams percent are, the CCI charts, and the stochastics. When we see these charts, that means that the upward thrust, because the bigger picture is still positive, the thrust that we're seeing right now is still positive, but it did wear down a bit in Friday's session. Intermediate term, we're coming down. So the context of the Sean trend meter, that's the CTM, is that it's turning more negative. It's come out of the really overextended area and dropped down to just the extended area. And even with the decline, we're still far away from the 50-period moving average. That's what the boom indicator measures. No change. Now, we're going to get the FOMC meeting minutes in the upcoming week. The market will be dissecting that to say, okay, what were they talking about? Who wanted a rate cut? Who didn't? What things are they pointing out? And that's going to be released in Wednesday's session. So a few days ago, the market was really thinking, wow, we might get a 50 basis point cut or 0.5%. Well, now they're like, okay, we're hoping for a 0.25% cut in September. And if we start seeing more inflation data coming out going forward before that meeting, it might even take that 25 basis point cut that they're anticipating. It might even take that off the table as well. That's how these things can change over time. The dollar was down, all right, and interest rates were up. So we're at 4.33%. Yeah, we're below the 4.5% level, but we've been working our way back up. And for the week, interest rates also were up because now when we see inflationary pressures, that pushes interest rates higher. Sentiment is still positive. It really was unchanged. We're at 64, unchanged from what we saw after Thursday. We are positive with the trend, and we are in a strengthening trend now because we're above the moving average and we're above 20, and the green line is above the red line. But with the down day, the bias is negative. I'm still keeping the momentum at positive. That mainly is because of the short-term indicators. Our list, we have 3 out of the 4 on the list currently. Economic reports. Retail sales came in as expected, up 0.5%. So not a real big impact there. Last time it was up 0.9%. If you take out autos, also came in as expected, up 0.3%, but down from the 0.8% that we saw in the last report. Empire State Manufacturing, stronger than expected, 11.9. They thought it would be unchanged. Last time it was up 5.5. And then I don't have charts for these. We'll just go through them because the scenario out there is, okay, if inflation is going to be a problem, we're going to see import prices start to go up. And that's what we saw here, up 0.4%. Last time they were down 0.1% because these tariffs take time to work their way through the economy if that's what's going to happen. And then import prices, when you take out oil, they were up 3%, where last time they were down 0.3%. Export prices actually came down. They were up 0.5% last time. This time they were up 0.1%. If you take out agricultural products, the same thing, up 0.1%. Last time they were up 0.5%. Industrial production, a little bit of a concern there. Is there some economic weakness coming in? It was down 0.1%, but that was as expected. Last time it was up 0.4%. Capacity utilization also came in as expected at 77.5. Last time it was at 77.7. Business inventories, a little bit of a tick up there. It was up 0.2%. Last time it was unchanged, and they thought it was going to come up 0.1%. Consumer sentiment, little bit of a drop there after it had been improving. 58.6. They thought it would come in at 61.3. Last time it was at 61.7. Okay, so here are some charts. Retail sales year over year, kind of flat. Now, I'll show you a chart probably that'll come out over the weekend that when retail sales are flat, that's quite often precedes when we go into a recession. But we've been flat now for quite some time and we haven't had a recession. But we're not seeing a real drop off either. Because even during a recession, people still need food. They still need toilet paper. They still have to go buy things anyway. So this flattening, we'll just see if that ends up leading to something. Month over month, retail sales were positive, but they did decline from the previous month. And then industrial production. We have production in blue. That's actually showing a year-over-year increase, where capacity utilization, are all the factories and trucks and all the equipment, is that being used to its full ability? That's actually ticking down a little bit now. And then here is the capacity utilization. It's below the 78 level and declining a little bit after it had been, well, it was improving for a while and now it's starting to level off. Then industrial production, month over month, we were starting to see this going up. Now it dropped to negative. Then the New York Empire State Manufacturing, that was actually a bit of a surprise to the upside. We had been negative going through the spring and early summer. Now it's showing a continuation of improving there. And then business inventories had been declining. Now they're starting to go back up. And this is when companies make things in a very simplified way. and they don't go out the door. They're not delivered. They actually sit on the shelves. And when this really goes up, that can also be a problem of that the economy might be struggling there. Okay, then consumer sentiment. This is broken out into three different areas. The total reading is in blue where it came down. And then we look at the purple line. That's how people are feeling right now. There's a lot of apprehension coming back in. And then the yellow line, that's how people are feeling looking out into the future. And all of three of these did decline. Then I show this chart here, and I put the 2-year treasury yield, which has been declining as well. Consumer sentiment had been improving, but now it's starting to fall back a little bit. We did see a nice little move up last time, but then it declined in the latest reading. Okay, then looking at confidence of small businesses and then comparing that with small cap stocks, where we earlier on we saw the Russell 2000 doing well. It's still in an uptrend. It created a golden cross not too long ago. Now the S&P 600, the other small cap, okay, the other small cap index that we follow, that has yet to generate a golden cross. That isn't showing as much strength now. But we have in orange where the Russell 2000 had been going up, but the last couple of days it's been going back down. And then how is the confidence in small businesses? We're actually seeing that coming down a little bit, where these tend to go more hand. Excuse me, one more time here, and I'm going to pause this. Okay, sorry about that. We'll see how long this lasts this time. I do all these videos take one. Actually, I take a drink of water. I did a bunch of talking before I started recording. Doesn't seem to matter. All right, but we're seeing a bit of a disconnect here where these lines tend to not get very far apart. You could make a case that they're kind of far apart. Does that mean that confidence is going to come down and small caps are going to go up? Or are we going to see them both go down and get a little bit closer to each other? Then looking at the trend, and this is like a detrended way of trying to measure, are we getting too far out of line here? Where this is the trend of the S&P 500 right here with a trend line that they put on here. And then they say it's over or under the trend line growth. Where we're above this upper dashed line here, which means we might be getting out of hand. But we've been that way before, and then we came back down a little bit below the dash line. Now we're starting to go up. This could suggest, according to this chart, that maybe we're getting a little overextended, and they call this overbought, and that's longer term. This goes all the way back into probably the 1920s. Here's the 1929 crash. No, it's right after the 29 crash. Then this is the Great Depression right here. Okay, then earnings, tech against the rest. So you have U.S. tech stocks, and the trailing this is looking at tech, media, and telecommunications. Here, that's in blue, and that's the growth area, and that's what really leads the market higher. And that's still looking quite positive here. When we go back to 1990, you take out all the other stocks, and it's going up, but not with as much enthusiasm. Tech is still the big growth area for the market. Earnings sentiment continuing to improve. We had a pretty good earnings season. It never really ends. We just have a period of time when a whole lot of companies report at the same time, and then it slows down a little bit, and then we wait for the next quarter, and then a whole bunch of reports will come out again. So when you look at the U.S. for the S&P, folks are feeling more positive about earnings when compared to the rest of the world. And length and severity of bear and subsequent bull markets. This is why I'm not a perma bear, and I don't understand anybody that is. First of all, that means you're always looking for the negative, nor should you always be a perma bull, meaning that you're always looking for the positive, which is a good thing, but we have to be perma realist. That there's when the market goes up, there's times when the market goes down, and this just shows you these are the shorter times when the market goes down and the longer times that the market goes up. So yeah, it's like if you're a perma bear, you're going to be wrong at least about 70% of the time right off the bat. And that might be good for baseball, but it's not very good for the stock market as far as a percentage basis. So, and then we're trying to plot out here what has been happening up to this point here, and then the different periods of time that are marked on the chart. And this is just going out the number of months here. Okay, then energy positioning. Now, again, I try to explain this. Energy is usually considered to be defensive, but you could make a case that it's also a growth area because of how everything is switching over to AI and electric vehicles and all the massive amounts of power that are needed. They're starting to open up nuclear power plants again. And but that's a growth area, but it's generally considered to be more defensive. But we're seeing some money coming back in. And if you watch these videos on a regular basis, except for oil, it's been going down. But energy, the whole group, has been really improving lately. All right, and then this is outdated. My gosh, this is so last Tuesday. S&P 500 hits a record of CPI not as bad as feared. Well, okay, it's in the latest post from Isabel Net. Where's the PPI chart? That's the one that really came out and has the market a bit more concerned. Then the dispersion of stock returns has widened sharply. So we're seeing generally a net positive here. That just shows that most of these over a 3-month distribution period, they are showing returns that are positive. All right, then retail sales. On the surface, steady and solid consumer momentum. Under the hood, a rising share of sales growth is being paid for by inflation. That's what they're trying to show you here in this particular chart. But the chart itself is showing it's holding up and it came out as expected. When you see the word real in here, real control group sales, that means that inflation is taken into account. And import prices, again, we did see those numbers earlier on here where it was up 0.4% month over month in July. Well, if you take out oil, it rose 0.3. Both were the largest monthly increase since blah, blah, 1952 or whatever. I don't like it when they try to do comparisons like that. And I know a lot of people do it. This is the highest increase since 1992. It's like, okay, you're telling me probably a factual statement, but it's completely useless because you don't know the context. What was happening at this sense time that you're referring to? We could have been in a downtrend at that time, and now we're coming back up and hitting that same level again. The whole context is completely different. Okay, that's just where I come out on that one. Then foreigners against the U.S. Treasuries here. Foreign investor holdings in treasuries rose by 80.2 billion, the highest since 1923. This is a record. So we have a lot of foreign investors who are buying U.S. bonds. Now that's okay, and they're allowed to do that. And I say they, meaning that they're not U.S. citizens. But if they have to suddenly sell these things because things are going wrong in their own country, that's going to push prices down and interest rates up. This was an Edward Yardeni chart here. Then ETF leverage. This is kind of a concern now. Now, if you belong to my program, where I go through some trade ideas every day, and when we're looking positive or negative, we have what are called enhanced or leveraged ETFs. There are even enhanced or leveraged mutual funds that you can have access to, which is great when prices go in the direction that you want to go in. But when you're wrong, you're losing twice as fast. Or if you use a 3 times leveraged ETF, you're going down 3 times as fast. And people want to focus on what you can make, not what you can lose. Well, we're seeing a lot of people leverage long versus inverse ETFs under management. And we're seeing a lot of people into these leveraged long type of positions, which again is great when they're right, but they bail on them pretty quickly. And you can see losses mount up very fast when they end up being wrong when you compare it to the inverse. Now, I use both of these. I use the enhanced, or I use the SPY. I don't use enhanced ETFs because I like to hedge things, and I use a lot of options, and there are option strategies that I do. So I just stick with the SPY. But when we're going down, there's an inverse SPY, which it goes up 1% in value if the SPY goes down 1%. I use that, but I don't go to the 2 or 3 times. But I have people that watch my videos and are in my program. They do those. And so I'm like, okay, here's the information if you decide you want to do that. Because I found that the options for hedging and the way to protect yourself, because that's my first rule, is protect yourself. Then after you protect yourself, now let's focus on making money, where it's the reverse for most people. I want to make some money. I don't care about the losses. It's automatic. It's going to happen. The stock market is nothing more than a cash machine. It doesn't always work that way. And but the options behind are not quite as liquid. And I like to get into things that I can get into and out of quickly. That's my rationale behind that. And if you disagree with that or if you have another strategy, leave me a comment, send me an email. Let me know what you think about that. Okay, then sector margins here and number of companies that have reported their profit margins still looking pretty solid here, but falling in most sectors compared with 2024. All right. So we're still seeing positive earnings, but they're not as robust. And I've said that over and over and over. That's when back in 2024, we started to see things slow down as far as the momentum in the market itself, but the earnings were still good and people are still feeling good about earnings. They're just not projected out to be as robust as they were before. And general business conditions, here we have the current, that's the reading here, feeling a little bit better. We're expected, they're actually thinking things are going to get a little bit worse here. And then these are times when the US went into a recession, which we're not in a recession right now. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, here's the intraday chart. Higher opened, went right up to R1. That was the intraday high. That was also an all-time high. We got a little bit above the high that was set back in Wednesday's session. We tried to get up there, but didn't quite on Thursday. We did get above it, but this, somebody bought right here. I mean, how do you feel about that? If you're like a day trader, you got in at exactly the wrong time. And then we came down from there below the unchanged level, below the daily pivot. We did find support here at the S1 level, and we went back up to the daily pivot, came down, and then ended up closing at S1. So almost at the low for the session, even though we kind of roller coastered our way through the day. And then things are fairly calm. We saw a little bit of a bounce in the initial overnight session as things close for the weekend. And this is a little more defensive. We're still seeing the red line above the blue line, but they're both going down right now. When it's more positive, it's when we see the blue line above the red line, but it's pretty much flat over the last few trading sessions. This is where it's a little more concerning for the S&P. This is the intraday growth to value ratio. It's a 10-minute chart. And we had been doing well. And we had that big down day at the first part of July, but then the trend still, we went another day down about July 22nd, and then we bounced up from that. Well, we've been kind of topping out and going sideways. Now we're starting to go down a little bit. Now we're not really seeing that in price yet. August and September tend to be weaker, especially in post-election years. We have yet to have a positive August going back to 1950 during post-election years. This year could be different, but it could also end up turning out to be the same as what we've seen before. This is giving us a little bit of concern, the fact that these are tending to trend lower. Then the end of day charts, where growth was down more than value for the large caps, it was down less for the mid caps and down less for the small caps. So we're just kind of moseying along sideways here with our small cap growth to value ratio. But you can see we had those couple of good up days and now we're starting to work back. A pattern we've seen many times before. Mid caps actually underneath the 50-day moving average, where mid caps are looking better. Now they're starting to give some of that back, but in the bigger picture, the ratio is still positive. Starting to drop below the 50-day moving average with S&P growth to value. We haven't been below the moving average now for quite some time, but the bigger picture is that we are still positive. And near the highs here with this growth to value ratio, but off of those highs. And we did see a little bit of an improvement earlier on with discretionary to staples, but now we're just kind of chopping along sideways. And here is the short-term trend where we are positive, and it shows a strengthening trend because we've crossed back above the moving average with the green line above the red line. Intermediate term, same thing, above the moving average, green line above the red line. So the intermediate term trend is still positive. And we picked up a little bit with volume, but we're still below average here. You can see the histogram showing lots of red. We spent pretty much in fact, we did spend the whole week below average with volume, which is not a surprise given that we're in the middle of August. We did tick up a little bit with the VIX, but we're still well below 20, and we're still below the moving averages with the line chart and the bar chart. This is what we're watching for. It hasn't really happened yet. An increase in the VIX means stocks are going down, but that has yet to really transpire. And we're right a little bit above the moving average here with the VIX of the VIX, which this measures the volatility of the VIX itself. So we're seeing volatility picking up just a little bit. We're above the moving averages with the bar chart and the line chart. And still up in this red area when we look at the skew index, which is a variation of the VIX, the market's still expecting some kind of a big move. We don't really know if it's to the upside or downside at this point. We saw a bit of a tick up with this fear gauge and a little bit of a tick up with this other fear gauge. So there is some fear coming back into the market. We saw a little bit of that in the VIX, but we saw a real drop off with the daily chart of the equity put call ratio. Now, Friday was also options expiration. So a lot of those options could have ended up, they were being dumped on the market because they're getting ready to expire. And we're coming down with the 5-day chart, which is positive, and we're coming down with the 10-day chart, which is usually positive when this chart is going down. And we're coming back into the high end of the range after we were getting a really high reading with volatility risk premium. So this is more back to neutral now. And we did decline, but we're still looking positive in the bigger picture with the advanced decline line based on price and volume. We declined, but we're still above zero with the short and intermediate term advanced decline ratio. This still is going up, though. This is a 10-day advanced decline oscillator. We're above zero and continuing to climb. So that's still holding up quite well. And we're looking better here with our new highs, new lows. And it's not that we're seeing much of an expansion of the new highs. They're actually dropping off. It's that we're seeing pretty much no new lows in the S&P right now. And so the lot more green than red, and that's causing our 5-day and 10-day chart to continue to go up. That's still positive. We did decline, but we're above the moving average with accumulation distribution. We're starting to drop below the moving average with the shorter term indicator, which I call the boom indicator, which is really just a modified MACD. And we're negative here. We're actually going down a bit with the red line with the Chaikin money flow. So in the short term, we're seeing things more negative. Bigger picture, we're still positive. We also declined with the Chaikin oscillator. That's negative, but we're still positive because we haven't dropped below the moving average, at least yet. And we're not really seeing any strength out of the vortex right now. The green line's been going sideways, but so has the red line, pretty much going back to the beginning of August. But it's positive with the green line above the red line. And we're seeing a little bit more of a deterioration when we look at the S&P, which has been holding up a little bit better than the NYSE advanced decline line. That took a bit of a hit on Friday. So we did decline with our advanced decline line studies, but we're above the moving averages with all the indexes that we follow. We declined here with those stocks in the S&P above their 20-period moving average, but we're still above 50. We saw a bit of a decline with the 50-period moving average study. We were pretty much flat with the 100-period moving average study and a decline with the 200-period moving average study. But they're all still above 50, so they're treated as positive. So here is one of the dashed lines. Now, this is a daily chart. This isn't the overhead resistance that I'm talking about. I'll show that here in a little while. But we're kind of right on this pivot point. We've been seeing a nice, healthy pattern here. Now, a week ago, folks were thinking, oh, this is a bearish flag, and we're failing to get above this previous high here. We're going to come back up here, fill the gap, and then tank. Well, that could still happen, but we've surpassed this previous high to set new all-time highs, but we're right at this pivot point currently. And on the bottom, you can see where we were below average, which is kind of strange for an options expiration day. We saw a little bit of a hit with the 20-period moving average, 50 and 200, but all of these are still above 50. And this is the one short-term indicator that's not extreme positive right now, the Stochk RSI, but it's still above the midpoint where we came down, but we're still extreme with the Williams percent R, CCI 14, and CCI 20, and all three of the stochastics charts. Even though they're declining a little bit, the first two, this one is still going up. That's the long short-term stochastic. We're still positive here, extreme positive. And we declined, but we're still just about at the midpoint with the force index. We're still going up with the green line and the blue line with the short-term trend. That's still hanging in there, showing the short-term trend is still intact. And we're still in the +2 channel with the standard deviations chart. That's still positive for the time being. We continue to be below zero with the balance of power. And when we were going up, I was trying to point out this negative divergence here, and we really haven't seen a lot of strength. We were going up and setting new all-time highs. We didn't even cross back over positive with the balance of power here, and then it declined in Friday's session. So it's picking up some weakness that it sees here, but we're still positive with the go, no go with the darker blue bars. We're still just coming off the highest high value. That's still positive. We're 74 days into this current uptrend that we've been in, according to the Landry Light. And usually it gets a little bit long when we get beyond 40 days. Well, we're at 74 days now. We're still positive with the proper order. We're actually seeing some improvement here. We're positive now with the TTM squeeze. After the S&P was going up, this was going down, producing a negative divergence. Now it's starting to track more of what price has been doing. And still just barely positive with the ease of movement, as it's been flatlining for the most time above zero. So it's slightly positive. We did tick up a little bit here with the Arun. Saw a little bit of an increase in buyers, a little bit of a drop off in sellers. That's why the oscillator is going up, and it's above zero. So that's positive. And this is negative though. This is the McClellan oscillator for the S&P. We were positive. Now we dropped down below zero. So we're starting to roll over based on price, but we're still going up based on volume. Now that could be positive if volume holds up and price sees a little bit of a hit, because when volume tends to lead price, that is more positive. But that can also be more negative if we're going to the downside. But right here, seeing some weakness in price, not really coming in and seeing it based on volume, at least yet. We also dropped down below zero from a broad market perspective with the NYSE McClellan oscillator. So you can't really see it here, but we're ticking down slightly with the summation index based on price and volume. Now we're negative. We're going down with the swelling trading oscillator based on price and volume, but both are still above zero. And we're still improving here. The momentum oscillators, they're slower and they were starting to improve. So they're looking better. We're actually a little bit extreme here with the PMO. We were trying to cross above the moving average here based on price, and we're just a little bit below the moving average based on volume. So a little bit of a drop off, but still below 50 with the PMOs in the S&P that are rising. The buy signals are slowing down, but they're still going up. It's still below 50. Still seeing a little bit of an improvement here with the PMOs in the S&P that are above zero. And we've gone from positive over to neutral with the Elder's Impulse system. We're still positive with the parabolic SAR. We're back above the moving average here with our short-term slope oscillator, and we're still below the green line. We're also getting a little bit above the moving average with the MACD, which in my opinion is more short to somewhat intermediate term. This is one of the first momentum oscillators that people usually learn about when they study technical analysis. So looking at all of these, still looking better in the short and intermediate term. We're still negative in the long term, although both the TRIX and KST are trying to turn up. And we're starting to turn positive with the Copic curve. So it's like momentum, which lags price a little bit here. It's like, okay, if we start to see more weakness, this could be giving us some false signals. And we're coming down, but we're still extreme with the Sean trend meter. Where we had been in the dark green area, the context is now that it's declining. We did decline, but we're above 50 with the money flow. Excuse me. And we're also still above 50 with the ultimate oscillator, still above an advancing moving average with on-balance volume. We came down, but we're still above 50 with the RSI 14, where we were barely extreme positive, but we dropped down a little bit with the short-term RSI. It's still looking good here with the green, orange, or red and blue lines here. They're still going up with the bow tie method. The intermediate term trend, we're still going up with the red line and the blue line. That's still holding up for right now. We're still above all the plotted moving averages, and we're not too far away from the 20-period moving average, but even with the decline, we're still far away from the 50-period moving average. That's what the boom indicator measures. And we're still positive with the bullish percent index, and it actually advanced a bit in Friday's session. So there is some buying going on internally in the S&P. And we're still positive overall with the NYSE bullish percent index. We ticked up, but we're still negative with the NASDAQ 100 bullish percent index. It's below 50. This is the chart that I was talking about. This is the longer term pivot point. Notice where we closed just a little bit below it. So we have not broken above this overhead resistance. This resistance is at 64.68. I rounded up. It's actually 64.67.59. I rounded up to 68. where we tried to get above it and we were a little bit above it either earlier in the week or even in Friday's session, but we closed below it. So for right now, this resistance is still in play. We haven't been able to close above it. But when you look at the bars here, these are weekly bars. These still look pretty constructive. Higher highs and higher lows since we were coming up out of the April lows. So the market's still having to deal with this. Is this going to present some kind of a problem? Now, you might want to pause this, and you can see other times when we hit these pivot points, that ended up being a really big deal for the S&P. Is it going to become a big deal this time? That's the question we are asking. But we're still positive with the hike in ASHI. We're still positive with the KEGI, Renko, and three-line break charts. Long term, coming down a little bit, but still positive with our 150 and 200 period moving averages. Still positive on all time frames across the different indexes. And we're switching to negative in the short term with bonds, and we're negative in the long term, but the intermediate term is still holding up. Commodities are seeing some weakness now in the short and intermediate term, where the dollar continues to be negative on all time frames. So we saw healthcare, and again, there might be some bargain hunting in there because it's really been underperforming the S&P. Now, if that continues to look better, that could be defensive because healthcare is a defensive area. And if people are really buying that now and it's showing some improvement, that could be that the market is getting ready to decline because defensive stocks hold up better if we go down. We also saw a bit of a bounce with real estate. Communication, that's a growth area that was up, but we saw staples up a little bit here. Where the financial sector, it was the weakest area. And then we had tech. We've been watching financials, but tech, that's another growth area, and it just didn't have a very good day. So we saw some real positive things right when the market opened, with the S&P setting a new all-time high, the Dow, and the Dow was above 45,000. Didn't stay there, but that you can see over on the right-hand side. This is 2 or 3 minutes right after the market opened, up to 5 minutes after the market opened. And then not a lot happened. And then eventually later in the day, just before lunchtime, that was when the NASDAQ crossed below 21.6. So an awful lot of red over here. That's why the market was really struggling. When you have Apple, Microsoft, and Nvidia, even though these declines are not very much, they're red. And you had Tesla down, Amazon virtually unchanged. We saw a lot of weakness here in the financials. And we're a bit concerned about that. Where we saw in communication with Google was up slightly and Meta was up slightly. And then healthcare, a lot of green in here. I think it was Eli Lilly came out. So one of the companies came out with their earnings and it was well received. And then here's the all-time high, but then we closed almost at the low for the Dow, but we're still in a longer-term uptrend. Still positive with the Elder's Impulse system with the diamonds. And we're also back to dealing with this R1 pivot point with the NASDAQ. We got above it, and now we're starting to drop below it. Is that going to be important? And we've gone from from positive to neutral with the NASDAQ with the Elder's Impulse system. Also, we're just right about on the pivot point with the NASDAQ 100 here. And we've also switched over to neutral with the QQQs with the Elder's Impulse system. We are positive. I mean, after months here, we were negative with the NASDAQ 100 as it was going up. But now that we're starting to go down, it's been improving. We'll see if there's more follow through with that. Now, one thing you might want to notice here is when we saw this crossover, this is not coming from an extreme reading. If you remember, here's March and into April, we were just going down, down, down. And then we finally bottomed and started to come up and cross above the moving average. Well, this was at a much lower level. This is happening above the midpoint now, which means even if we see some positive momentum, it might be rather limited. And we're still above the trend line going back to 2009 on the weekly chart of the NASDAQ 100. Now we're starting to give back some of the small caps from the S&P 600. Now, we could still come down even more, but as long as we stay above both of these moving averages, it will eventually generate a golden cross. And we have seen a recent golden cross with the Russell 2000 small caps, but they're starting to give back some of their gains as well. We've gone from positive back over to neutral with the small caps and starting to give some back here with the mid caps. They're also working off of a recent golden cross and back to neutral with the mid caps with the Elder's Impulse system. Down a little bit, but recent all-time highs with the Wilshire 5000 and the total U.S. stock ETF. Here's the financial sector, down over 1%, but still above its 50-day moving average. And as I've been pointing out, this chart looks pretty good. You go back to the beginning of 2024, And this has been a pretty solid uptrend. It got hit with everything else when we were declining earlier in 2025, but then it recovered nicely. Where the concern comes is the ratio between the financial sector and the S&P. We're down below the 200-day moving average, recent death cross here, and that ratio is continuing now to go down again. And coming off of recent all-time highs here with the FANG index, the really big stocks. So Apple was down 0.5%. We had Amazon virtually unchanged. Microsoft has been down, but still in an uptrend. It was down 0.44%. Google was up almost 0.5% and in an uptrend. Nvidia was down 0.86%, but still coming off of recent all-time highs. Meta was up 0.4%, still holding up fairly well there. And Tesla, which has just been chopping around, it's like a real bumpy road here. I hope those EVs can handle that. It was down 1.5%, coming back down to its 200-day moving average. And Netflix was actually up and it's starting to get back above its 50-day moving average. So a little bit of strength there. We're seeing more of a correlation in the short term between US and world stocks, starting to turn up ever so slightly with the longer term correlation. And we're down into the 63 range with oil. We'll see if some of the talks over the weekend or if anything happens geopolitically. That's really why we watch oil, because it can really go crazy to the upside or downside depending on what happens geopolitically. The dollar, we're down below the 50-day moving average and we're in a longer term downtrend here on the daily chart. And we're going up overall with the 10-year yield, but we're still below this red line, which is at the 4.5% yield level. And we're coming down here with the 10-year based on price. And we're coming down, but still above an advancing moving average. When we look at the ratio between the Qs and the S&P, we are improving with discretionary to the S&P, but we're flat in Friday's session. But when you compare large cap growth to value, we're still above an advancing moving average here. So the large caps are looking good, but now we're starting to see some more weakness. We're below the moving average with the mid caps. Even though we bounced, we're below the moving average with the small caps. All right, so what about Monday? We're still kind of dealing with earnings season there, but it's not as big as it had been. And we're still positive on all time frames. We're still seeing some of these negative divergences, which still seem to be improving. Now we're just starting to see some more weakness possibly coming in, but we do have overhead resistance. I have a question mark here because it's like, are we going to be able to get above that? We did not get above that yet. And then we're going to, oops, I forgot to update this. So I'm going to go to the next slide here. And then the geopolitical things that are going on. So this is the updated calendar. I forgot to update the previous slide. Not really big. We're going to get the NAHB Housing Market Index on Monday. Little lighter week. We'll get the meeting minutes on Wednesday and then jobless claims on Thursday like we always get. There's no economic reports for Friday, but Fed Chair Powell is going to give a speech. And so the market always hangs on to whatever he says. And here's also a look at the upcoming calendar. Seasonally neutral to positive for August 18th. When you look at the Dow and NASDAQ, where we are positive going back to 2002 for the S&P 500. We're done with options expiration. Now we're dealing with the week after, and we tend to be down more than up. We're up 45% of the time and down 55% of the time. And here's a look here. We're during post-election years, typically what has happened. Now, we have not really seen that materialize, at least yet, but we're halfway through August now. Is that going to finally start coming into the picture, or is the market going to be able to get more positive and break and set new all-time highs and negate what we've seen historically happen? And this is historically, going back to 1950, all the post-election years, we have yet to have a positive August. This also shows how August tends to be more negative. This also shows how August is more negative. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, so now on the negative side, we have the S&P and NYSE McClellan oscillators and summation indexes. They were positive. Now they're back over on the negative side. And the Swindle Trading oscillators now declining. And the bullish percent index for the NASDAQ 100 is still below 50. And it's improving, but since it's below 50, that's why it's negative. And we have a longer term Zohorchak method sell signal. It is improving. It was at a -10. That's a full-on sell signal. It's improved to -6, but it's still at a -6. And then I'm keeping this on the positive side for right now because you could make a case in the bigger picture, accumulation distribution are positive. We're still above the moving average with the Chaikin oscillator, but we're just flat out negative when we look at the Chaikin money flow. So a mixed picture here. And our longer term growth to value and discretionary to staples ratios are still positive, even though they're starting to take a hit. Parabolic SAR is positive. We're turning back and looking more positive with our momentum oscillators. The bullish percent index still positive for the S&P, and it's still above 50 for the NYSE. And the ease of movement, money flow, and ultimate oscillator, even though they took a bit of a hit, they're still all above 50. And the vortex, even though it's flatlined for the most part, it's still seeing the green line above the red line. And the momentum for the NASDAQ 100 is also back to looking more positive. Financial sector, when you look at it by itself, it's just we're concerned how it's underperforming the S&P 500. Is that a warning sign of some kind? And then the long-term special K chart. I've stopped showing that. I'll just show it in the weekly video for right now and some of the videos that I do over the weekend. But it continues to be positive because we get so few signals from that chart. Here are the pivot points for Monday's session. They're already posted on the website and they'll be available on the YouTube community tab as well. So the conclusion, still positive. We're still dealing with that overhead resistance on the weekly chart for the S&P. And we are seeing a strengthening trend now in the short term, and we still see positive conviction. Not all of our charts, and they came down a little bit on Friday, but they're still showing good short-term momentum. In the intermediate term, we're also generally seeing an improvement there, and some of the negative divergences are still continuing to improve, but now we're seeing a little bit of weakness starting to come in. Long term, we still are considered to be positive. Thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.